All right, JP, you ready to go?
Ready as I'll ever be.
All right, let's do this. Hello, everyone, and thank you for joining our first ever Pensford interest rate webinar. We are so grateful that you are here. For those that recognize my voice, I'm Sarah Conklin, co-host and producer of the Rate Guy podcast, and of course, the real boss here at Pensford. I'll be introducing JP after a few housekeeping notes. We will be sending out PDF slides post-meeting. If you want a recording, you can email us at pensfordteam@pensford.com. If time permits, we'll have a brief Q&A session at the end, so you can post your questions throughout the webinar, and we'll pick a few for JP to answer. If you haven't heard of the Rate Guy podcast, you can check it out nearly every Monday on wherever you get your podcasts. And now, here is our resident interest rate expert, JP Conklin, in all his reluctant glory to geek out over inflation, interest rates, and of course, J Money Pal.
All right, thank you, Sarah. Sarah wanted me to first make sure that we did a short commercial for Pensford and LoanBoss. She said we've got 5 kids and Christmas is coming up, so we got to make sure that we pay the bills. For those of you that have been leveraging our resources over the years, but maybe haven't actually worked directly with us, some people are surprised to learn that we do interest rate caps and defeasances and swaps and all things like that. We specialize in sports smack talk, so please feel free to send that over as well. On the LoanBoss side, it's a software company that I started in an attempt to serve a very underserved market with commercial and multifamily real estate. That's just a very antiquated way of managing debt. So we've got live interest rates and automated calculations, hyperlinks to the loan doc, so you can just get one click. It's a super cool software. We're really proud of it. And I think the thing that we hear most frequently after a demo is, wow, that did way more than I was expecting. Across both companies, what I would stress is whether it's transactions or it's software, we're in the relationship business. And so what you're going to hear today is one of the ways that we try to differentiate ourselves from our competitors is we love talking about interest rates. We love doing analysis. We think that we build relationships between the transactions, and then the transactions are just where everybody gets to have the most fun. So please don't ever hesitate to reach out. And as Sarah said, we will make sure that we send all this stuff around. Last thing I'll mention is I am not an economist. I'm just a state school kid who's been working in interest rates markets for going on 20 years now. And so these are just observations. I don't have any formal training, and some of that will probably shine through as we get started. Also, you can tell it's our first webinar because we scheduled for 10 a.m. East Coast, and I've gotten a lot of hate mail from the West Coast about us cutting into their surfing time. So going forward, we will do a better job of scheduling this so that people on the West Coast can join. And we plan on doing these quarterly until rates get boring again, and then we'll pull back and stop doing them. We can all go back to ignoring interest rates. But for now, here's what we got. Let's start with inflation. Hot topic for the day. I am stunned that some people thought that we would not have an inflation problem. When I look back over the last 2 years, it was totally obvious, and I can't believe that people are still surprised inflation ended up not being transitory. I went back and I searched for some headlines to remind myself how far behind the curve some people were. I saw a quote that said the Fed would love to have an inflation problem back from December 2020. Don't buy the inflation hype headlines. Worrying about inflation is like worrying about the Cowboys making the playoffs. Sure, technically it could happen, but don't we have a lot of precedent to suggest otherwise? I saw a forecast that said core PCE will finish below 3% this year. And then lastly, like the ceiling for Jalen Hurts' top line is game manager. No way he can be a real player. I even found a cool meme that somebody put together that had the audacity to claim that inflation is not a thing. Unfortunately, all of those came directly from yours truly. So I was one of the people who absolutely did not see inflation becoming such an issue this year, rooted largely in my experience post-financial crisis and all the stimulus and the quantitative easing and the 0% interest rates. This would be a good time for you to say, you know what, I'm not going to spend the next 45 minutes listening to this guy talk about rates if he was this far off on inflation. The thing to keep in mind with inflation right now is it's a monthly number that people are looking at. The annual number is not the headline. I know we see that in the Wall Street Journal, but what economists, what the Fed are looking at is the monthly number. Is it accelerating? Is it decelerating? And the last CPI print and the last core PCE print monthly show deceleration. It shows that it's working. The problem is we had a similar pump fake over the summer. So there's no guarantee that this is a trend. Whether or not this becomes a trend will largely dictate what the Fed does in Q1 of next year. If we see December and January continue to show deceleration with inflation, it will give the Fed cover fire to ease off, downshift to 25 basis points, maybe pause entirely. If not, they will hike more than is currently priced in. But it's the monthly numbers that matter right now, not the annualized numbers that we see in the Wall Street Journal. The annual inflation appears to be coming down. It'll be interesting to see how this plays out next year. Couple different things to keep in mind. We went back and looked at the Volcker era, which we're going to talk about here shortly. But during the Volcker era, at its fastest, excuse me, inflation only cooled off about half a point a month. So if we were to continue that sort of pace, it would be this time next year before inflation hits 2%. So this is not going to go away anytime soon. And that's probably a pace that we won't experience all of next year. Instead, I would expect to see some stops and starts. And it wouldn't surprise me if we're still dealing with inflation above 2% at the start of 2024, maybe even moving into 2024. I think the other thing to keep in mind is there is some chance that inflation will cool off and then become more and more stubborn the lower it gets. Like we might get down to 3.5% and it just refuses to budge. And then the Fed's going to have to figure out, is it time for us to change the goalposts, or do we want to stick with our 2% goal in the near term? If the Fed is winning a war on inflation, it's inflation expectations. So you can see 1, 2, 5, and 10-year inflation expectations mapped out since Jan 2021, and they peaked in March just as the Fed was started hiking aggressively. And since then, they've come slashing down. We have since rebounded from the lows of a couple months ago, but we're still in the 2.5% range. This is the biggest reason Powell is not going to change his rhetoric. He does not want to concede the hard fought ground from winning this war on inflation expectations. If he allows these to become entrenched, it'll be that much harder to actually tackle underlying inflation. So he's not going to throw in the towel because he just doesn't want to see this tick back up. As I mentioned, we've had a lot of discussions around the Volcker era and whether or not we're repeating that. And it's actually really interesting when you go back and look at it. We think of the Volcker era, I at least think of it as the late 70s, but it was really kind of the early 80s. And so I consider this the Mount Everest of inflation. Okay. Fed funds got up to 22%, CPI was 15%, and the unemployment rate was almost 11%. But this inflation story really began about 15 years prior, way back down here in what I like to call the Rockies. Inflation in 1966 broke 2%. That's this light blue, Tar Heel blue line right here. Broke the 2% threshold in 1966. It did not dip below 2% for 20 years. All right, we've been tackling this for 18 months. Imagine if we had 18 years to go on this. Inflation ran up, and I think maybe the misperception when we look back and we evaluate those Fed officials is they were asleep at the wheel. But look at this dark blue line with Fed funds. They hiked aggressively. They took Fed funds up to 9%. They weren't asleep at the wheel. They were doing the same thing that the Fed is doing now. Where they made a mistake is on the downside when they started cutting rates, which we know the Fed always ends up doing, they let off too soon. I think this letting off at the 2.5 to 3% number is what then set off the K2 of inflation post oil embargo, which is inflation starts climbing, they start hiking, and we repeat the cycle with a higher peak now. So this is K2, Fed funds up at 13%, CPI over 12%. Same pattern. Fed starts cutting as inflation is falling. This time they let off way too soon, 5%. Okay. So when that next cycle began, 5% was the starting point, not 2%, not 1%. So that set in motion this cycle where we saw CPI run up to 15%. Volcker said, you guys screwed up by letting off too soon. I am going to take us to really painfully high levels and then drive inflation down to 2%. And then here's the sort of cautionary tale as we move into next year, which is it got down to 2 and then it actually rebounded to 5, right? Powell has these lessons in mind right now. I think Powell behind closed doors says, we're experiencing the Rockies, and I am not going to saddle a successor 10, 15 years from now that has to take rates to 20% because I was unwilling to drive inflation below 2% today. I'm not going to do that. And I think that's going to be really formative for how he makes decisions next year. Here's what this looks like today, which is inflation peaked, CPI peaked at 9.1. The lesson here, and this is not drawn to scale, but the lesson here is I think he's going to keep Fed funds higher for longer just to confirm that this goes down towards 2. He does not want to let off too soon. He wants to step on the throat of inflation, push this down to 2%. He rides off into the sunset, pulls off a mini Volcker. 10 years from now, we don't need 20% interest rates. What that means in the near term, however, is we're probably going to endure higher rates for longer than we would otherwise. So this sort of Fed funds at 5+% for the foreseeable future. The thing about rate hikes and inflation is it doesn't roll over immediately. I think that's one of the misconceptions about this year. Powell came out in March and said, we're going to pull this lever, but we're not going to expect to see an impact on inflation for 12 to 18 months. And he was thinking of this graph when he said that. We do not accept that. We read an inflation headline and we say the Fed is asleep at the wheel. They got to do more. They got to keep hiking. Powell is stuck between a rock and a hard place because he's saying, listen, guys, there's a natural lag here. We start pulling this monetary policy lever, hiking rates, it's a while before inflation starts falling. Okay. On average, 2.5 years. So the fact that we're seeing any cooling off is atypical right now. The real numbers we're going to see falling off is this time next year, 2024, right? Unfortunately, markets and we are not patient enough to tolerate that. So we're forcing Powell to keep hiking north of 5%, ignoring the fact that there's a lag. I think it's mostly an issue of optics right now. He might genuinely believe it's time to lay off and just pause and evaluate. 5% of tightening in a year is plenty. Let's see how this plays out. But if the inflation monthly numbers come out hotter, he can't because of the optics. So let's shift gear a little bit and talk about some leading indicators that we like to look at. Number one, you're probably seeing this by now. Supply chain pressures are starting to ease and frequently had started to ease before the Fed hike. It's not as if the Fed pulls the lever and all of a sudden all the ships off of the LA port get waved in, okay? It just needed time. And we have seen a huge improvement over the course of this year in supply chain pressures. So this is the own New York Fed supply chain index. You can see we're back down to 2020 levels. So we've seen substantial improvement. There is still risk here. We don't know what's going to happen in China. We've seen some of that shifting over to Europe. Now Europe is engaged in a protracted war with Russia. And so there's all these potential risks out there about constricting supply chains. But I think in general, the headlines we're seeing from the shipping companies is demand has fallen off a cliff. We have empty containers. We're pulling way back. Prices have gotten crushed. We're going to ease off of how many containers we put out there because demand has just been totally destroyed. Here's a graph that a client sent to me about a year ago. It was, I think, December of last year. We saw this huge drop in shipping containers off of the LA port, right? And this is what I sent around. There was no red on my graph. It just looked like this. And he sent it to me and said, hey, that's actually false. What they started doing was pushing ships further out. And so I went back and looked, and he was right. They pushed them further out and they stopped counting them. They just changed the methodology. So I started tracking this graph instead. And what we've seen is this number is now down to 0. 2 weeks ago, they reported anchored or loitering at 0 ships. It is a fundamentally different picture today than it was at the start of the year. It's dramatically different. This will have an impact on inflation. It's just a matter of how long is it going to take in order for that to flow through. GDP, both domestically and globally, is expected to fall pretty dramatically. I think one of the key themes next year is going to be Powell focusing on global developments. This year, it's all been about domestic. We've got to cut off inflation. We've got to drive that down. Labor market's super strong. We can absorb this. That has ripple effects around the globe, particularly emerging markets. I think Powell will have to start to consider global developments more and more the further we get into this tightening cycle. This time next year would not surprise me if Powell is actively considering global developments in monetary policy decisions. We will lead that charge. We're slowing everything down. Everybody else is going to slow down that much more. And then lastly, in the leading indicators, this is also an index. There's actually a leading indicator index, and it's got a really good track record of predicting recessions once we get down to about 0.7%. And the most recent reading was negative zero point 0.8. So we've hit that threshold. This strongly suggests that we will have a recession within the next 12 to 18 months. This does not usually have a false flag once we get to this level. So we're going to spend a lot of time talking about floating. If you're primarily a fixed rate borrower and you want to go to sleep, now would be the time. I bring this up to say, 2022 was supposed to be relatively calm. Back in November, Fed said that they weren't hiking at all, and there's evidence of that right down here. So this is from December, but this is from the September projections, basically no hikes in 2022. You can see from September to December, they changed their mind and they said, oh, maybe about 3 hikes we're going to see this year. But they also said inflation is going to run 2.7 this year. And I found this quote from Powell back in November that said, we don't think it's a good time to raise interest rates because we want to see the labor market heal further. He stopped by the office, never mind this cardboard cutout looking stuff. That's pure coincidence. We had him pose with the picture. He, of course, had his purple tie on. That is an actual cardboard cutout. We're that geeky here that we have a cardboard cutout of Jay Powell. But it's interesting that not only did they raise substantially, Exhibit A for why they're raising substantially is the labor market, when in November they were saying it's too soft in order to hike. You've probably seen a graph like this that just shows how much more exaggerated this cycle has been. I used to tell clients all the time, when the Fed cuts rates, they slash and burn. It's 50 basis points, 75 basis points. Get down 3%, see what happens, maybe go more. When they hike, it's a slow grind higher. It's 25 basis points every meeting, 25 basis points every other meeting, very slow and steady. This is totally different. This has been the slash and burn higher. It will be interesting to me to see what the resulting fallout is from this. Because as you can see, as we look forward, rates start tracking lower in most scenarios, right? Will the fact that we had to accelerate this and pull forward these hikes translate into a much faster decline on the far side? One of the things I don't think gets enough attention is real rates. Okay. I understand that Fed funds is 4%, probably headed to 5% by the end of Q1. It almost doesn't matter when real Fed funds, which is accounting for inflation, are still negative. From the Fed's perspective, this means we have not even really applied the brakes to the economy. We still have room to go. So for the people that are expecting a pivot at the December 15th meeting, I would be skeptical. I might see a downshift. I think 50 basis points is probably locked in, but a 25 basis point feels premature, and I don't think they're going to change the language around these hikes. I think it's too premature to send that signal when you can just wait a couple months, see how the inflation data comes out, hike accordingly, and if they end up saying, hey, we're going to pause after the Feb 1 hike, markets will be happy. Everybody will be happy. But if they do a pump fake and say, hey, we're thinking about downshifting, and then the inflation comes in hotter, they're going to have to ramp back up the rhetoric, and that causes a lot more volatility, which is what they're trying to avoid. So I would carefully monitor this. We should move into positive territory heading into the new year. That's when they'll start to consider a pause, not before, because we're still dealing with negative real rates. The San Francisco Fed puts out this PROXY Fed funds, which attempts to capture other things like forward guidance, right, and quantitative tightening. And what their PROXY index says is Fed funds is really behaving as if it's at 6.5%. I know we're at 4, but when you factor in the other stuff, it's behaving as if we've hiked 6.5%. So I do think that this will give the Fed the cover fire necessary in Q1 to start to level off and say, we've done a ton of tightening through quantitative tightening, through forward guidance. We've done way more than just 5%. We're actually more like 7% in tightening in 1 year. That's dramatic. Let's press pause. He won't do that unless inflation is showing a trend lower. So we've got a meeting next week. Right now, it's basically locked in that there's a 50 basis point hike next week. I would be very surprised if it was anything else. The February one is now sort of split 50-50 between 25 basis points and 50 basis points. I think the base case is 25, but if we get one more, inflated inflation reading, 50 basis points is what's happening. Like, they're not going to let off yet. We do not have a light at the end of the tunnel yet. The market is pretty optimistic after that. However, you can see we're sort of 0% going the further out we go. And the Fed has changed its tune. For the first time since they started hiking, the Fed is at least talking about a pause. We're not there yet, but they're at least referencing a downshifting. So that says to me that it's on the horizon at some point. Now it's a matter of when we can level off. Is it March? Is it June? So here's the infamous Harry graph. So basically, how accurate is the market in predicting the path of rates? The solid blue line is what LIBOR has actually done since 1990. Okay, that's just the graph that you guys are all used to. The spaghetti lines, the gray lines, are the forward curve at various points along the way. So I love to look at sort of 1991 because the Fed was cutting rates pretty aggressively. But even as they were cutting from 8% to 6%, the forward curve of the next 5 years still said rates are going right back up. Okay. In general, the market always overestimates the path of interest rates. When you see this gray line above the blue line, it means we're overestimating. For most of you on the call, you can probably remember the last 10 years, we always had an upward sloping forward curve, and that's not what happened. We just stayed kept bouncing along at zero. The circles, however, are when we start hiking. And when we start hiking, the market underestimates the path of rates. Okay, the gray lines are below the blue lines right here. Okay, so Q4 of last year, particularly November, December, we were sending out a lot of emails saying, I thought that the Fed was not going to hike this year, and I was still saying, but markets and history have told us they're going to hike, and we're underestimating. Now, I had no clue it would go anywhere remotely close to 4.5%, 5%, but history tends to repeat itself, and we see the market just consistently underestimated the path of rates once they started hiking. Coincidentally, that is the best time to lock in a rate is right before the Fed starts hiking because the market is still underestimating the path, but they haven't started hiking. So you benefited from floating without converting to fixed, and then you lock in right before rates take off. Here's a measure of inaccuracy. We're going to show you two different graphs of inaccuracy of the forward curve and sort of like an order of magnitude. And what you see is it's the most wrong right before recession. So this makes me think about 2023. Okay. Look at how wrong it gets right before recession. You're talking on average about 3%. It gets pretty wrong. Right before a hiking cycle, it's also wrong the other direction, but not quite as much, more like 1.5% on average. So you guys should have on your radar at some point when the Fed stops hiking, the market is probably overestimating. We're going to have a recession sometime, and rates will be overestimated on average by about 3%. And that's the same thing you see on this graph, just kind of expressed differently, which is on average from the day they stop going out 6 or 5 years, on average, we end up about 3% overestimating the path of rates. If you were to look at the absolute peak in interest rates, how far off are we? Almost 5%. And if you look at tightening, cutting cycles, easing cycles, it's more about 3.5 to 4%. So it's pretty dramatic, right? Most of us believe there is an easing cycle at some point. And what that suggests is there is a time on the horizon when we will be overestimating interest rates pretty dramatically, just like we were underestimating them coming into this tightening cycle. The thing with tightening cycles is they don't last that long. If you go from the first hike to the first cut, so not even when they pause, not even when they stop, but just from the first hike to the first cut is on average about 2 years. The longest is 3.2 years. Now we've cut this off at 1990. If you go back into the 70s, it's the same thing. You may recall the Volcker graph. It's highly volatile. They were hiking and then they were cutting, and then they would hike again, and they would cut again. But the pattern remains that in general, the backside of the curve is pretty steep as the Fed ends up slashing and burning rates. If the Fed has not started cutting rates by June 2025, it'll be the first time in history they've gone that long without cutting rates. On average, they will be cutting by June 2024. Another way to measure this is from the last hike to the first cut. So the pause, right? And so I sort of think of March as the base case for the pause. On average, within 9 months, they're cutting interest rates. Okay. So that means if they pause in March, history tells us they're probably cutting by year end. Now, I think this time might be different because Powell's going to want to keep rates elevated for longer to ensure that he wins the war on inflation. But the longest ever is 14.6 months. It's not a long time. Whenever they're done, that's when we've hit the light at the end of the tunnel. They are now on the clock before they start cutting. We went back to see how good of a job does the forward curve do of predicting interest rates on the last day or the day of the last hike. So let's pretend March, for example. We get there, they hike one last time, they say, we're done, we're pausing, we're going to evaluate. The blue dashed line is the forward curve. Okay, this is a 2016 2018 cycle. So on the day of the last hike, this is what the forward curve suggested, basically flat for the next 3 years. What actually ended up happening, however, was within a year we started cutting rates. COVID came along, the bottom fell out. Okay, so COVID's an extreme example. Let's check the cycle before that. Last hike, market said rates are going to be flat for 3 years. A year later, the bottom falls out. Let's check the cycle before that. 2000, day of the last hike, rates flat. Within a year, the bottom falls out. Okay. 94, 95 is the one time the Fed could probably argue that they achieved a soft landing. And that's because they backed off. They got rates up to 6, and then within a year, they had taken out 75 basis points of hikes. I think there's a chance that this Fed mimics this, that Powell says, we've won the war on inflation. We no longer need to be in restrictive territory. Let's take some of these hikes out. If they get up to, 5.25, maybe they drop back down to 4.5, 4.25, 4, something to avoid a total slash and burn, and extend the economic expansion, but also easing off, saying we don't need to maintain 5.25, 5.5% for the foreseeable future. So even though the bottom didn't drop out, the thing that I would note is the discrepancy between reality and expectations was still more than 2.5%. So even if we get to March and the forward curve is upward sloping a little bit, what it suggests is within the next 3 years, it's probably going to be wrong by at least 2.5%. And if we back up to the cycle before that, we go back to the same old pattern, which is day of the last hike, rates are flat. In reality, the bottom falls out and we see rates plunge. So that leads us to, well, how much warning do we get when the Fed is going to cut rates? So I went back to the last 3 cycles and just did a Google search. These are actually not attributed to me, so no embarrassing quotes here. But you'll see in March, there was an article that said Fed signals no rate changes are coming. In June, Fed says no rate cuts until 2020. July 19th, Philadelphia Fed President Harker says no rate changes this year. July 31st, 11 days later, the Fed unanimously voted to cut rates 25 basis points and started an easing cycle. Let's back up to 07. Those of us still in the business remember 07, 08 very fondly as a pretty exciting time. February 2007, New York Fed President Dudley said the market turbulence that began in earnest on Feb 27 is now a distant memory. Risk appetites have recovered, volatility in the fixed income and equity markets have declined, and U.S. equity market has climbed to a new high. All right, so that's Feb 07. For those of us who are around, June was a different story. But notice that in June, the headlines are still saying cuts are now off the table. A hike, in fact, may be coming. Markets had a 40% odd of more rate hikes by year end. And there was an August article that said Fed focus unchanged, meaning we're either hiking or doing nothing, but we're not cutting. By September 18th, they were cutting 50 basis points. And back in 2000, there's even fewer things available on the internet. Fed leaves rates steady, but indicated that inflation is still a risk, stoking fears that future rate increases may be in store. That's from October. November, Fed holds rates steady, but warned it may not be done with hikes. Jan 3rd, they cut by 50 basis points, right? So keep that in mind next year, that just because we're not hearing talk about cuts doesn't mean that they aren't coming. One of the things that's kind of driving me nuts about the headlines I'm reading is how resilient the job market is, which I believe it is. Things are going reasonably well in the labor market, and I think wage pressures are absolutely at the forefront of Powell's mind when he's making these decisions. But I don't think that they inform Fed monetary policy. We keep waiting for like job losses to materialize as an indication that the hikes are working. And instead, we just keep hearing about how resilient the job market is. So we went back to the last 4 and just said, okay, when the Fed paused, Fed stopped hiking, how were job reports coming in the 6 months leading up to the pause? Okay. So in 2018, the 6-month average was 139,000, and the month prior to the pause was 248,000. Okay. Last month was 263. Go back to 2006, 6 months average, 195,000, right? You can see some downshifting heading into the pause, but there were months where it was over 300,000. There was probably headlines about how resilient the job market was back then. In 2000, 6 month average, 273, stronger than last month's report. And look, they even had a 473 print a couple months before they paused. 95, same thing. 6 month average, 300,000. Okay. So to me, seeing these numbers of 263 does not mean that the job market is not resilient. What it means is has nothing to do with when the Fed's going to stop. We should stop expecting payrolls to turn negative just because the Fed is hiking. And in fact, if you go back and look, there's usually at least a 2-year lag from when they start hiking to when we see job growth turn negative. So we're reading these headlines expecting them to say negative. It's like we still have another year to go before we would expect jobs to be negative. At a minimum, it's a year. So talk to me in March or April about this. In some cases, it's longer. In the last cycle, we ended up not seeing it until COVID. Same stat, but with unemployment. Unemployment, this is really amazing to me. Unemployment doesn't start climbing until the Fed is cutting. That's how big of a lag there is with unemployment. So we should not be looking for unemployment to surge to 4.5% or 5% as a signal that the Fed is going to start cutting, or even that they'll pause. That's going to happen a year from now, right? We should buckle up for these false headlines about a resilient job market and why the Fed can't stop, because we're going to keep seeing it. But that's not going to have a lot to do with what the Fed decides to do Q1 of next year. Real quick, talk about hedges. Negotiate those interest rate floors. I know that it's a throwaway item. I know there's not many closings right now, but when you have an opportunity to negotiate a floor, do it. These things are going to be extremely expensive 2 or 3 years from now, particularly if they get set at wherever SOFR is on the day you close the loan. You should focus on this. And if the lender refuses to budge, just remember you can buy a floor out the same way that you can buy a cap, and just allows you to float back down. These are really cheap right now. We gave you some examples over here where, hey, I basically want to have a floor at 4% where SOFR is. Cost me 260 grand. You're going to save way more than that if the Fed follows previous patterns. Okay. And there's also ways to do it so that you don't have to buy it out entirely. You might say, I really just want to benefit down to 2.5%. If it goes below that, that's okay. I don't mind missing out on that. I want to lower my upfront cost. There's a lot of ways that we can structure that. Obviously, on everybody's mind are caps. And cap prices are up tenfold. Everybody knows that. But what was interesting to us is, as people would ask us, when are cap prices going to settle? What we realized was it's really all about when the Fed stops hiking. And to me, that reflects the volatility component of a cap. A cap has two main components. It's expectations, which is a forward curve. How much am I going to have to pay you back if I lay out the forward curve next to the strike? And then volatility. How uncertain am I? Right? Go back a couple of years, uncertainty premium was zero. That's why caps were so cheap. Today, that uncertainty is enormous. November, the Fed said they weren't hiking at all. Now we're looking at 5+%. If I'm a trader, I feel like you're buying a lottery ticket for me. I don't know if the Fed's going to go to 6 or 7 or 8. I don't think so. But I sent out a lot of news blasts this year that said, hey, is SOFR going to be at 3% by year end? And then a month later, it was like, is SOFR going to be at 4% by year end? And then a month later, is SOFR going to be at 5% by year end? If you're a trader and you got to pay somebody back on this, you're buying a lottery ticket. And so they're going to charge you for that. Once they pause, however, costs tend to plunge by about 50% within 3 months and 75% within 8 months. So I do think if the Fed pauses in March, you'll see the volatility component get sucked out and cap prices will be way more manageable. If they don't pause until June, that's going to delay everything until fall of next year. But just know the pause is when caps start getting more affordable. So let's shift gears to fixed. Not nearly as much to talk about on the fixed side. But what I would say is the key technical levels are 4% and 3.25. I think there's a really good chance that we're range bound in that for much of next year. I am way more concerned about the 10-year Treasury popping in the near term than I am a year from now. I think there's a chance that the 10-year tests 4% again before year end, particularly if we keep seeing headlines about how resilient the economy is. Fast forward a year when all this tightening has had an opportunity to work itself through the system, way more likely that the 10-year Treasury is down towards 3.25, maybe even 3%. And most economists believe the same. If you go back to the last 5 cycles, you can see that in general, a year after, the 10-year Treasury has dropped by about 120 basis points. That put us around 313. And then the 2-year mark would put us down around 265. So this is sort of the implied. The one exception was the 94, 95 quote unquote soft landing because they backed off. If you hear about the Fed potentially backing off, that will create a risk on sentiment. People will think, hey, they're not going to kill us on this. We could actually take some risk. You might see rates pop up for a year or so. The trend is still going to be lower over the longer term because we will have a recession at some point. One of the things I've been really surprised about is how little of an effect tapering has had on financial conditions this year. This to me was the thing that was maybe most underappreciated headed into the year. I was totally wrong. It's had almost no impact. But as I think about what the Fed is going to do with tapering moving forward, I think that they're going to spend some energy next year trying to detach tapering from inflation. I think they're going to equate rate hikes with inflation, tapering with financial stability. If you guys saw what happened in England in about 2 months ago, that was financial stability issues. Tapering tends to lead to that sort of thing. Markets tend to seize up. So I think the Fed will keep tapering even if they pause. They will keep tapering unless we have financial instability. If we experience something like England did, they'll stop. They'll want to make sure that markets are liquid and everything behaves naturally. They will spend some energy making sure that we believe tapering is associated with stability, not inflation. That way they can stop hiking and keep tapering without inflation expectations surging again. Thing to note, however, is that liquidity levels are pretty depressed and we're back at sort of COVID levels. So treasury liquidity is not great right now. Now, don't be too scared by this. If I zoomed out and I included the financial crisis, this would look like a blip, okay? But in the recent history, excluding the financial crisis, the treasury market is pretty illiquid. This will be something to keep an eye on with the quantitative tightening that the Fed is doing. This would be the sort of thing that would cause them to pause on that. We have a lot of resources on our website. Everything's free. Encourage you to go there and find these, but I just want to include 2 things. We have a really intense fixed versus floating analysis paper. And what we found was over a long enough time period, floating always is cheaper. Now, I'll be interested to see how that plays out if somebody locked in 50 basis points when the 10-year was at 50 basis points. We'll see that if becomes the new exception. On the 2-year time frame, it is sometimes cheaper to be fixed, and that's this red section. These are the times it was cheaper to be fixed, and it peaked out at about 1%. This is all the tightening cycles. This is when we underestimate the path of rates. It was cheaper to lock in for 2 years. It's more expensive when you locked, and this is how much it costs you. It costs you close to 4%, okay? If you stretch that timeline out longer to 10 years, there's never been a time when it's cheaper to have been fixed. And I know there's a million business reasons why you would choose fixed. I know this time might be different. I'm just highlighting that in general, when you lock in fixed for 10 years, you end up overpaying by close to 4%. And the takeaways that we found when we look back on this, and they're highlighted up here, is when you're floating and you're wrong by a little. You're wrong by 1%. When you fix and you're wrong by 4%. It's a lot. It's painful. And that's before we even tackle prepayment penalties. So historically, the worst time to fix is when fixed rates are below floating rates like we're seeing today. And again, this time could be different. Just know in every other cycle, if you lock in at the peak, you end up missing out because right now the market is overestimating what's going to happen and the bottom tends to fall out. At a minimum, rates tend to drop at least 3%. And I think the message that we're sharing with borrowers is, hey, if this helps you sleep at night, do it. If you're a long-term holder anyway, do it. Makes total sense. If you're traditionally a floating rate borrower, be mindful about locking in today because you're not only locking in today's rates that may be substantially lower a couple of years from now, but you're also locking in pretty conservative underwriting terms. And I suspect 2 or 3 years from now, you're going to want to be able to refi. You're going to be used to floating rates, and that flexibility, and you're not going to have it. You're going to have 7 years left on a prepay. So looking ahead to next year, this is the single most important graph. This is my favorite graph. This is what the Fed uses to measure the success of their decisions. Okay, there's a lot going on, so bear with me. This gray line is the Mendoza line. This is the break-even point. When financial conditions are above it, it means things are restrictive. When financial conditions are below, it means things are accommodative. Okay, and this attempts to capture dozens and dozens of different data points, such as actual level of interest rates, real interest rates, inflation, commodity prices, volatility, forward guidance, quantitative tightening, quantitative easing, all those things into one sort of output and say, hey, how easy or hard is it to do a deal? So I look back at the end of 2021, start of this year, and say this is the busiest Pensford's ever been, and I would love to take credit for it, but it was probably because we had the most tailwinds ever, right? And I suspect a lot of people on the phone feel the same way. If you look at 2008, you can see this is what a financial crisis does to financial conditions. It's impossible to do anything. Okay. There's this yellow dashed recession line. It's more of an art than a science, but it falls around 101 and a half. Okay. In general, when we breach that line, we have a recession. So Powell starts talking about hikes, keeps talking about hikes. Conditions tighten substantially this year, probably the fastest ever. He has said we need to take financial conditions into restrictive territory. We need to go into this green. He's hoping he can avoid toppling us into the yellow because that's the recession. So in his mind, this is the soft landing that he's after. Okay. Back in October, we were barreling towards, I thought for sure we were going to breach it, and we didn't. It's actually eased quite a bit because we've had some progress on inflation, and all of a sudden it's eased. This is another reason why I think that they're going to keep hiking, because he's looking at this and saying, this gray dash line, from my perspective, is when I'm applying the brakes. I'm applying the brakes when we're above this line. We're now back below this line. We just dropped below this line over the last week. So he's thinking to himself, I've got rope. I can go hike some more without pushing us into recession, but get us back into this restrictive territory. One of the challenges he's going to have is, as you can see since the financial crisis, anytime we've been in restrictive territory, the Fed has gotten accommodative. So they announced 2.0, 3.0. They stopped hiking. They started cutting. COVID, obviously, the doors got blown off with all the accommodation. This time is different. They're saying not only are we going to take us into here, we're going to stay here. I want to continue here. This sets the stage for a misfire. This is why I think a soft landing is going to be a borderline impossible. In order to achieve this soft landing, they got to stop hiking pretty soon. It's worse around the globe, and this is why I think this is going to be a key theme next year. Global financial conditions. Here's us way down here. Everything is extremely tight. Now, this captures not only like Germany and England, but also all the emerging markets. So it's a different dynamic. But still, it is a totally different story around the globe since the Fed started hiking. You can see the pain that the rest of the globe is feeling. That's going to flow through to 2023. And that's why I think next year we're highly likely to have a recession. What's interesting when you look at recessions is you can usually boil it down to two things: rates and oil. That's it. And if one goes up but not the other, we can avoid a recession, right? We have two different examples where one went up but not the other, avoided a recession. But when they both go up, you have a gray bar recession here, right? And that's what we saw this year. Now, maybe this retracement will bail us out, but otherwise it follows the exact same pattern of the other ones, which is it goes surging, it falls down, we find out we're in a recession a year later. Yield curve inversion. Yield curve inverted on April 1st. Okay. That's when the 2-year treasury is higher than the 10-year treasury. It does a great job of predicting a recession. It does a terrible job of telling you when. It doesn't try to predict why either. We kind of had some snarky remarks after the pandemic about, hey, the yield curve inverted. You telling me that it knew that there was a pandemic coming? Obviously not. What it does say is the financial markets are strained to a point that it can't withstand a shock, right? And I think the shock right now most likely is higher interest rates and maybe inflation. In general, once the curve inverts, you have a recession about 18 months later. Okay. It inverted 4-1 of this year. That puts us fall of next year, which ties out nicely with what a lot of economists think. Powell even highlighted this in his most recent press conference. He actually prefers a more near term measure, and that curve inverted. So the entire curve is inverting We usually measure by the 2 year, but if you start pulling that forward and floating rates, SOFR is above the 10-year treasury, you now have a very deep inversion and a very high probability of a recession. Which brings us to the conclusion where there's been all this talk about the high correlation between Philadelphia sports teams and recessions. I'm a diehard Philadelphia fan. As you can see, anytime we do awesome, we tend to have a recession. So I was at game 5 with Sarah. We unfortunately lost. And so I think I'm willing to take a hit for the team and say, because the Phillies lost the World Series, I think maybe we're in the clear for next year in terms of having a recession until I consider that the Eagles are going to win the Super Bowl this year. So that locks in a recession for 2023, and you guys should plan accordingly. And feel free to join me in Philadelphia for the Super Bowl parade in early February. So I know we rushed through a lot of slides there. I will kick it back to Sarah to see if we have any QA, and we've got about 10 minutes, and we'll see what questions we can answer for you guys. Sarah?
There I am. Can you hear me okay? Okay.
Yep.
So we had a lot of good questions. We're not going to be able to get to all of them, but here is the first one. What is the best threshold time, 2, 5, 7 years, to choose floating over fixed?
The general rule of thumb that we use is 3 years. If something is 3 years or less, it's almost always a cap. If something is 5 years or longer, it's almost always fixed. In between is nuanced. Each case is different, each client is different, but I tend to think of 3 years and less as floating, 5 years and longer as a prime candidate for fixed.
Okay. Next one is, would you buy a 2-year or 3-year cap right now?
That's going to depend a lot on the business objectives and the disposition plans and the risk tolerance. My theory is rate caps are going to be substantially less expensive a year from now. So I would be reluctant to overpay for the third year in this market. What I would probably do is say, buy me a 2 year because it's highly likely that at a minimum year one is going to pay out. Um, and then I would set up monitoring. We have a lot of clients that we email monthly automatically. They get automated price updates and just say, hey, year 3 on the day that you closed would have cost you X. Today it's going to cost you Y. And they look at it and they say, hey, thanks, I'm good. And a month later, they get the same email. And a month later, they get the same email. Then eventually, something triggers a response from them. They say, hey, it's time for us to consider this. Because I think sometimes we treat hedging discussions like a snapshot decision that we make at the closing table, when in fact, to me, it's an evolution. And over time, we gain greater clarity around the interest rate market as well as the business execution. And we might not even need year 3 going out there. But if you're getting consistent updates, you're staying on top of it. In the interim, if something changes, you can move quickly and buy that third year. But I personally, in most instances, would buy a 2 year right now because I think that they're going to be falling pretty drastically a year plus from now.
Okay. What do you think are some factors that may have the potential to maintain the forecasted 2023 high interest rates through 2024?
Inflation. Everything is about inflation. Powell has said he's willing to tolerate a bear stock market. He's willing to tolerate climbing unemployment. Nothing matters right now except inflation. So if we don't see a turn lower in inflation, I think that the Fed is going to hike more than expected. I think it's more likely that Fed funds is at 5.5 than it's at 4.5 this time next year. I think there's a chance that we get into Q1 and Q2, and they're still considering 50 basis point hikes. It'll all be dependent on what that monthly inflation does. And I think there's a chance that we get up to 5.5, and they just say we're keeping it here for the whole year and just buckle up. We're willing to tolerate pain to make sure that inflation drives lower, and we don't want to see a sort of a rebound in inflation. We drive it down to 3.5. We think we're winning the war. We start to ease off, and then it suddenly surges again. I don't think any of that's going to happen. I do think it's going to keep coming down, but I think it might be a little bit more disjointed than a nice, even half a point drop month over month for the next 12 months.
While we're on that, where do you put the odds that the Fed has cut rates by the end of 2023?
Probably about 20%. It's not zero, as we've seen. History would tell us. We always underestimate how quickly the Fed will start cutting. But I think with the inflation story the way it is, we're going into this pause differently than prior pauses. and that they're more likely to say, we're going to endure pain. We're not going to react just because unemployment starts climbing. And that just depresses the odds. Normally, would have said 50%, maybe 60%. I'm going to round that down to 20% because I think they're just going to stick to it in the face of some economic pain next year.
All right, switching gears just a little bit on defeasance. Have you seen a lot of defeasance in the money to clients this year?
Yeah, so it's really the first time in maybe 20 years that the defeasances we've worked on have been in the money to clients. Um, and so it's one of those sort of wake up calls. So you almost forget that it's possible. But we've had defeasances that have been in the money, and we've had a lot of clients who were surprised that they were in the money. I think just like us, they just sort of assume there's some penalty. How bad is it? Turns out it's actually in the money, and it may not offset the drop in valuations that they've experienced, but at least it doesn't get any worse by having a penalty on top of it. Um, we have had a lot more clients look at ways of hedging defeasances by using swaptions. And they say, hey, listen, we're closing 60 days from now. I'm afraid that rates are going to actually drop and make this penalty worse. Is there a way for me to lock in this number? Because right now I'm going to get paid 100 grand if I pay this off. But 2 months from now, if rates move, I might owe 500 grand. Can I hedge that? And the answer is yes. There's really efficient ways to hedge those defeasance costs to make sure it doesn't run away from you in the 60 days to closing.
Okay, we've got a couple more. Hang on. By the way, this hasn't been irreverent enough. Somebody said he thought there would be more crypto talk. Um,
I
and
know less about crypto than I know about interest rates, and that's saying something.
and yes, a lot of people have asked about the slides. We will definitely send these slides out in PDF form um, to you all after this. Um, so not to get political, but what do you think, what type of impact, if any, do you see elections have on the interest rate market?
I think in general, elections have an overstated impact on markets. It's not zero, right? And I think if we go back to 2016, the biggest impact was really on psychology more so than the actual execution of policy. I had started Pensford back in 2009, and in 2012 was my first election as a Pensford owner. And August of 2012, business dried up completely. I mean, just totally ceased. Like all transactions stopped. September, October, and I'm just like, what is going on? I might have to close down shop and start dusting off the resume and go back to one of the banks. Um, and I had lunch with one of my favorite clients, and I was asking him about it, and I said, is it just over fear that a Democrat is going to win? Because my presumption was Democrats generally bad for the economy, Republicans generally good. Looked like Obama had a really good shot at winning. And he said, no. He's like, don't let real estate professionals tell you that politicians dictate how we make money. It's like, it might have a marginal impact. He's like, we just need to know what rules to play by. A lot of us were working in the early 80s during the Volcker era, and we made money just fine. We can definitely make money when interest rates are sub 5%. But we need to know what rules to play by. And a presidential election is the biggest threat to those rules. He's like, my prediction is once we go on the other side of the election, regardless of who wins, we will see deal flow kick back up again because we just need to know what rules to play by. And sure enough, December, January, February, we were off to the races. Um, and so I think about that right now with the Fed tightening cycle, which is we need to know what rules to play by. When are you guys going to stop hiking? Tell us what rules to play by. Once we do, we can all go back to work. Right now, we can't take 6 or 7% off the table. So it feels very similar to that. So the answer to the political question is I think it's largely overstated. I think especially the White House gets way too much credit, way too much blame for something that's probably far better controlled by Congress.
All right, we're going to end with some fun ones since some of you are using
Those
this
have
as an
been fun.
opportunity. Well, no, they were definitely fun, but these I think people are using it as an opportunity to talk a little smack to you. So since you can't stop me from asking, we'll go ahead and go. Neutral indoor field, all players healthy. My Cowboys versus your Eagles. Who you got?
Oh, Eagles all day. That's a layup. That's such an easy question.
All right. Have you ever lost a wager that made you profess your love for the Dallas Cowboys?
Oh, this is from the same person, isn't it?
It's different actually. You got some haters out there.
I did lose a wager that required me to profess my love for the Dallas Cowboys. I had to wear a Dallas Cowboys jersey to an office. In fact, I had to wear it all day when I was in Dallas for meetings. So I have had quite a bit of shame around losing to Dallas. I think I'm kind of like the forward curve. I'm always overestimating the Eagles against the Cowboys, and for some reason they just tend to have our number. So yeah, I've actually got a Dallas Cowboys jersey at home that I've had to wear before in public in Dallas.
So are you keeping it just in case you have to wear it again?
um, that's a good question. I don't know why I'm holding on to it. Maybe it's time to go home and burn it.
There you go. And last one, going to college football. What percentage of your hatred for Ohio State is rooted in jealousy?
um, 100%. I don't understand why Penn State can't be as good as Ohio State at all things. Drives me bonkers, and so it ends up manifesting itself as a pure hatred for that team and that program. And I really hate how they emphasize the when they talk about how
Mhm.
amazing they are. But yeah, 100% of it's rooted in jealousy, just like most of my hatred is.
The last question, and there were so many good ones. I'm sorry we can't get to all of them, but they're curious when the next webinar is. And I think you mentioned that earlier that we hope to do it quarterly.
Yeah, so we'll probably do another one in March. It'll probably be less intense than this one. This one's kind of like a year ahead look as well. But we'll look to do one in March, which should be good because we'll have greater clarity on what the Fed is doing, and whether or not you can start the clock on the Fed cutting cycle and cap prices plunging.
Awesome. And I'll do a little plug. The Pensford newsletter comes out every week. So if you don't subscribe to that, I would definitely do that. And the Rate Guy podcast is based off the newsletter. You get a little more color around some things, and a little more opinion and trash talk. But those are all available every week. And thank you guys I've got nothing else on my end.
All right, thanks everybody for listening. Good luck as you wrap up your end, and we'll talk to you next year.
Thank you, everybody.